Hello, everyone, and good morning. Thanks for having me here. My name is Jiseong, and I'm one of the technical managers from KASB. Today, we'll be going over IFRS 17 in Korea with a focus on life insurance. To begin, I will briefly provide a summary of accounting for life insurance under IFRS 17. Then we will dive into how Korean life insurance companies are handling these requirements. Then I will address some of the big accounting questions being discussed in Korea, and we'll answer questions pertaining to Nepal. Specifically, we'll first go through IFRS 17 and discuss the GMM and the VFA models. This tends to cover the most essential part of IFRS 17 for life insurers. After that, I will go into information concerning the practical applications of IFRS 17, which is probably what most of you are interested in. Then I will highlight key accounting policies in Korea and address practical issues regarding IFRS 17 in our jurisdiction. Final chapter will cover the responses in relation to the questionnaire that we received previously from Nepal. If time permits, we will have a Q&A session after we've covered our primary agenda. Answering the questions will be Mr. J. Park, one of the KASB board members, and me. By the way, this is a 2-hour-long session, so we will break things up with a 15 minutes break halfway through. After the break, we'll look at some of the practical challenges covered in Chapter 4 of the Korean accounting policies. Let's start with an overview of IFRS 17 in Chapter 1. IFRS 17 replaces IFRS 4 and is the first unified international standard for accounting insurance contracts. IFRS 4 is a transitional standard that was intended to be applied temporarily while IFRS 17 was being developed. As such, IFRS 4 broadly allows a variety of existing practices among different jurisdictions so as to minimize the burden of entities upon the first adopting IFRS 17. As a result, different accounting methods were applied across the country, and insurance accounting is now fundamentally aligned with those of manufacturing and banking sectors. In addition, because there was no provision that insurance liabilities should be measured to reflect updated information, their risks were not properly disclosed in financial statements. Thus, investors and financial analysts had real difficulty in understanding the financial performance of insurers and to analyze time series information of each company. To mitigate these problems, IASB finally issued IFRS 17 in 2021. This new standard provides consistent principles regardless of insurer's jurisdiction, which leads to improvement in the comparability of insurer's financial report and transparency enhancement by measuring insurance liabilities at their present value. IFRS 17 presents 4 significant effects on insurance accounting. First, convergence. It aligns with other IFRS standards for consistency in terms of recognition and measurement requirements. Second, fulfillment cash flow approach, which focuses on the present value of in the financial statement. Third, accrual basis accounting, which requires profits and loss to be recognized when insurance services are provided, not when cash is received. Finally, by aligning with profit or loss attribution timing and measuring insurance liabilities at present value, stakeholders have better access to profitability and solvency information. Now that we've covered the broader effects of IFRS 17, Let's turn our attention to implementation parts. The first step in applying IFRS 17 is identifying the unit of account. In practice, insurers typically pool portfolios of similar risk contracts. A portfolio is a group of contracts subject to similar risks and managed together. A typical product lines such as death, annuities, and other insurance are considered portfolios. And more than that, IFRS 17 requires these portfolios to be further divided into at least three groups. As I said earlier, a portfolio is a group of contracts subject to similar risks and are managed together. And these portfolios are disaggregated into three groups. Number one, onerous contract. Number two, contracts that are profitable with no significant possibilities of becoming onerous. And lastly, other remaining contracts. This separation is essential because entities should manage onerous contracts separately from the contracts that might be profitable. To elaborate, IFRS 17, like other IFRS standards, requires loss to be recognized immediately, while gains to be recognized when services are provided. Accordingly, it is very important to distinguish onerous contract from the one might be profitable, so it's not to cancel out profit and loss effects. Furthermore, contracts issued more than 1 year apart should not be included in the same group. After identifying insurance contracts, the next step is determining when to initially recognize them. IFRS 17 mandates initial recognition at the earliest of three possible points. A, the beginning of the coverage period of the group of contracts. B, the date when the first payment from a policyholder in the group becomes due. C, when the group becomes onerous. Importantly, if cash flows occur before initial recognition, they are recorded in other assets or liabilities until the contract is recognized. To be specific, if there are cash outflows prior to the initial recognition of the contract, entities should immediately recognize the related amount as other assets. Later than when entities recognize the insurance contracts, they de-recognize the exact amount of the other asset and simultaneously reduce the initial CSM amount. When recognition addressed, we'll now look at how we measure insurance liabilities under IFRS 17. There are three measurement models. The measurement models consist of the general measurement model, also known as the building block approach, the premium allocation approach, and the variable fee approach. The general measurement model is the most commonly used one for all contracts subject to IFRS 17. The PAA is typically for short-term contracts having a term less than or equal to 1 year, and for certain cases where it closely approximates the GMM result. The VFA is primarily for life insurers and less common for non-life insurers. We'll cover the GMM, the VFA model, in details later on. This concludes the IFRS 17 introduction. Now let's explore some of the technical details of the general measurement model. Let's visualize the GMM's building block concept. It starts with 4 components. The first block, right at the bottom of the slide, is the future cash flow. This is the sum of the nominal future cash flows related to the fulfillment of obligations during the contract period. The amount includes premiums, indirect expenses, etc. We'll cover them in detail later. And these nominal cash flows are then discounted to their present value, which leads to the effect of the second block, time value of money. This is the process of adjusting future cash flows by applying an appropriate discount rate to reflect the discount effect. Next, a risk adjustment is added after that. In other words, you compensate for cash flows uncertainty. This risk adjustment can be recognized as a cost or CSM once the uncertainty is released. The final block is called the contractual service margin, CSM. It is the amount that will be recognized as insurance revenue in the future as insurers provide services to their customers. The sum of future cash flows and the time value of money is the best estimate liabilities, BEL, and the BEL plus risk adjustment equals the fulfillment cash flows under IFRS 17. Now we'll go over each of the blocks in detail. Let's break down the first block, future cash flows. Here, understanding the contract boundary is very important as it determines which cash flows are included. For example, a single 10-year contract has a clear boundary, but when your renewal options come in, it can get complex. I mean, a 10-year contract with 3-year renewals raises a question like, is the boundary 3 years or the full 10 years? IFRS 17 clarifies this. The boundary extends as long as there is a substantive right or obligation between the insurer and the policyholder. To elaborate, cash flows are within the contract boundary as long as the entity can compel the policyholder to pay premiums or the entity has an obligation to provide to the policyholder with insurance contract services. Additionally, IFRS 17, paragraph 34 states that even if the insurer cannot alter terms for a specific policyholder, the boundary still holds if they can do so at the broader portfolio level. Furthermore, the future cash flows incorporate all reasonable and supportable information available about the amount, timing, and the certainty of future cash flows. They also reflect the perspective of the entity and existing conditions, as well as future assumptions made at the date of measurement. Entities should establish future cash flows based on explicit cash flow that estimated separately from the adjustment for the time value of money and RA. Let's discuss the components of fulfillment cash flows. Primary cash flows include premiums and these direct expenses, whereas indirect expenses and investment-related components are excluded. Moving on, I'll address the second block, the time value of money. Once we calculate the nominal cash flows, we must discount them to present value. Discounting is a concept that reflects the time value of money and financial risks for the future cash flows. The discount rate is critical and should reflect the nature and liquidity of the contract cash flows. And importantly, IFRS 17 requires excluding some irrelevant items to the insurance liabilities, such as credit risk. This is because to avoid artificially lowering the insurance contract liabilities amount, also, entities may also choose to either a bottom-up approach or a top-down approach to calculate discount rate. IFRS 17 allows a flexible approach in calculating the appropriate discount rate. There are two approaches, as I said earlier, the top-down and the bottom-up. The top-down approach uses a market yield curve for peer groups and removes contract-specific characteristics. On the other hand, the bottom-up approach starts is a risk-free rate and as a liquidity premium for the insurance contract. IFRS 17 acknowledges that the amount calculated by the two different approaches may differ, and therefore does not require a reconciliation between the figures. The standard also allows both the bottom-up and top-down approaches, depending on entity's policy. The third block, risk adjustment, accounts for non-financial risks, which means the uncertainty surrounding the amount and the timing of cash flows. This is the compensation that the entity would require to make a difference between A, fulfilling a liability that has a range of possible outcomes arising from non-financial risk, and B, fulfilling a liability that will generate fixed cash flows with the same expected present value as the insurance contracts. For example, let's assume that there is a contract with a 50% of probability of being 110 or 90 in the future. In this case, RA is the compensation that makes an entity indifferent between the contract and the fixed cash flow of 100 within the same period. In addition, IFRS 17 doesn't prescribe a specific calculation method. Techniques like confidence level approach are common, but if a different model is used, entities shall disclose that method and its corresponding confidence level as well. Finally, the contractual service margin aligns with accrual accounting principles. Let's see how this works. Before we adopt IFRS 17, premiums were immediately recognized as revenue in Korea. However, under IFRS 17, revenue recognition occurs as insurers provide services over the coverage period. Therefore, the amount received in advance is recognized as CSM, which is in line with the concept of unearned revenue under other IFRS. After the initial recognition of CSM, entities remove the amount related to the service provided and subsequently recognize revenue. CSM is calculated as the difference between the present value of cash inflows and outflows. Large cash inflows generate a positive CSM, while large expected cash outflows lead to negative CSM. This is called an onerous contract, and the difference are immediately recognized as expenses. Let's switch gears to the subsequent measurement. At the initial recognition, the insurance liability consists of BEL and CSM, but it is then divided into a LRC and LIC during the contract period. The LRC is a liability recognized in the financial statement, reflecting entities' substantive obligations, such as insurance services to be provided. The LIC, on the other hand, refers to a liability for the incurred claims causing entities to pay benefits to policyholder. In the next slide, we'll take a look at the subsequent measurement of the CSM. There are several factors to take into account when calculating the CSM as of the end of the reporting period. First, when entities recognize new contracts, CSM increases under the condition that those contracts are not considered onerous. Also, as time passes, the discounted amount unwinds, resulting in interest expenses that increases CSM. Outside of that, experience adjustments, changes related to future services, and currency exchange effects are the factors that affect the fluctuation of CSM. For further information, currency effects are recognized as investment income or expenses in the income statement. Among the multiple factors that I listed earlier, I'd like to highlight the CSM amortization amount. This is the most important factor when it comes to estimating insurer's future performance. If the actual assumptions are in line with the initially estimated assumptions, the amortized amount in CSM is equal to the insurance revenue. Theoretically, we can estimate and compare each insurance company's performance with CSM amount alone. And let's look at CSM amortization amount in a little more detail. CSM is amortized on the basis of a group of contracts. Also, the coverage units of CSM can be identified in accordance with entity's policy. Once entities identify the coverage units, CSM is amortized by certain criteria determined by considering for each contract the quantity of the benefits provided under a contract and its expected coverage period. Moving on to the recognition of insurance revenue and expenses. Let's break it down to each block. The amount of amortized CSM in accordance with systematic methods under IFRS 17 is recognized as insurance income in the income statement. Furthermore, the risk adjustment is recognized as insurance revenue or expenses as the the risk released over time. For the time value of money, IFRS 17 allows both PL approach and OCI approach. If an entity chooses to disaggregate between PL and OCI items, interest expenses that measured by the discount rate determined on initial recognition is recognized as investment expenses. On the other hand, the effect of changes in the discount rate as of the end of the reporting period is recognized as OCI items. This is because the discount rate is highly dependent on external macroeconomic variables. Thus, it might not appropriate to recognize all of the effects in net income. Therefore, IFRS 17 allows room for entities to recognize the portion of related amounts as OCI items affecting the equity side. To summarize what we've learned so far, here's how insurance contracts should be presented and disclosed in the financial statements. Starting with the asset side in the statement of financial positions, the changes from the previous standard include the recognition of a new insurance contract assets and the reclassification of securities. In addition, there's a newly introduced concept of insurance contract assets, while deferred acquisition costs of new insurance contracts are no longer recognized as an asset, while previously was allowed under IFRS 4. On the liability side, insurance liabilities are required to be measured at present value and then categorized by elements such as BEL, RA, and CSM. Moving on to the statement of financial performance, the insurance service result consists of the allocated amount of CSM over time and the differences between the actual and expected amount, and that's all. And in addition, interest expenses and foreign exchange gains and losses are classified as insurance finance income or expenses. Let's turn to the last part for the general measurement model. In this section, we'll discuss examples for applying the GMM. The first example is the initial measurement of the BEL. The key concept here is that the BEL is equal to the present value of expected future cash flows. So as shown in the example on the slide, If the amount of premiums received is 900 and the present value of cash outflows from expected benefits is equal to 545, the BEL is calculated as 355. Let's use the same example to figure out how to measure risk adjustment. In this example, RA is calculated using the provision for adverse deviation method, which is called the PAD. The PAD method is kind of commonly used in Korea as well as the confidence level approach. And according to this method, RA is the difference between the BEL and calculated amount, which is attained by applying more conservative actuarial assumptions. We assume a probability distribution for each risk factor and set the specific percentile to derive adjusted cash flows. You can see the adjusted cash flows are calculated to be 235 and the BEL is equal to 355. And as a result, RA should be 120. Now shifting to page 22. Under the assumption that the contract is not onerous, you can see the CSM is 235. I will elaborate upon this. CSM is equal to the total sum of BEL and RA and should be larger than 0. Therefore, given the BEL is equal to negative 355 and RA is 120, CSM should be 235. Now turn your attention to examples related to understanding how to recognize insurance revenue. First, we'll cover the case of recognizing insurance revenue resulting from CSM allocation. The CSM is calculated as 200 initially, which is the difference between the expected amount of premiums and benefits. The CSM is recognized as revenue over time, and we assume that it is allocated over the defined coverage period. Therefore, insurance revenue is 40, which is calculated as 200 divided by 5. Moreover, the next example is about onerous contracts. Under IFRS 17, once the expected loss occurs, we immediately recognize the corresponding value in the income statement. As you can see in the middle of the slide, the expected benefit is greater than the expected premium. So as a result, we recognize 100 as the loss in the P&L statement, reflecting the expected loss immediately. Finally, the last example of recognizing insurance revenue is related to an event where there is a difference between expected and actual cash flows. Insurers analyze the expected and actual cash flows every year, and if there is a difference in the cash flows related to the insurance contract liability, the amount is recognized as profit or loss. For a specific instance, let's look at year 3 of the example on this slide. We can see that the actual claims exceeded the expected ones by 20, which reduces the profit. The implication of this example is that the ability of insurers to manage actuarial assumptions has become more important as we adopted IFRS 17. So far, we've discussed the concept and the application of the GMM. Let's move on to the third section and discuss the VFA model. First, we'll cover the concepts and eligibility criteria for the VFA, and then take a look at similarities and differences between the GMM and the VFA. Finally, I will present main components of this approach. This slide concerns the contracts subject to the VFA and the eligibility criteria under IFRS 17. The VFA is applied to insurance contracts with direct participation features, including variable insurance. Variable insurance refer to the contracts which fluctuate in their premiums or surrender value, etc. This is taken from the specific terms like distributing investment return to the policyholder based on the performance of funds, which consist of premiums. Also, the variable fee is a revenue that insurers receive from the policyholders in exchange for providing services, such as asset management. This variable fee is calculated by subtracting the insurance share from the performance cash flows, which do not fluctuate with the performance of underlying items. In conclusion, variable fee approach is for the insurance contract with direct participation features. These contracts are substantially investment-related service contracts under which an entity promises an investment return based on underlying items. Under the VFA model, insurers are obliged to pay the policyholders the exact amount of fair value of underlying items subtracted by variable fee. IFRS 17 outlines some criteria for these contracts. The standard defines 3 eligibility criteria in paragraph B101. Insurance contracts meet all 3 conditions can apply the VFA. We do this eligibility test once at the contract inception, and there's no reassessing process afterwards. I'll go through these criteria in detail. Firstly, the contractual terms specify that the policyholders participate in a share of a clearly identified pool of underlying items. A share referred to in paragraph 101 does not preclude the existence of the entity's discretion to vary the amounts paid to the policyholder. However, the link to the underlying item must be enforceable. To be specific, IFRS contends that contracts featuring implicit practices which allocate a substantial portion of underlying items are not eligible for treatment under VFA. According to IFRS 17, paragraph B101, the standard implies that profit allocation becomes unenforceable in the absence of written contracts. Furthermore, IFRS highlights that if a contract enforceability is limited to specific countries, the VFA can solely be applied within those jurisdictions. And for the underlying items, they can comprise any items. For example, a reference portfolio of assets, the net assets of the entity, or a specified subset of the net assets of the entity, as long as they are clearly identified by the contract. An entity need not hold the identified pool of underlying item. Secondly, the entity expects to pay to the policyholder an amount equal to a substantial share of the fair value returns on the underlying items to apply the VFA, which means the entity expects a substantial share of the fair value returns on the underlying items that will be paid to the policyholder. And paragraph B101 also requires that the entity expects a substantial proportion of any change in the amount to be paid to the policyholder to vary with the change in fair value of the underlying items. In this paragraph, substantial refers to the percentage insurers allocate to the policyholder, excluding any commissions exchanged for investment-related services provided by insurer that link to the underlying items. The precise figure is left to the discretion of each insurer to determine based on its fee structure for investment services. Lastly, the entity expects a substantial portion of any change in the amount to be paid to the policyholder to vary with the change in fair value of the underlying items. And under the paragraph B107, an entity shall assess the variability in the amount over the duration of the insurance contract and on the present value probability weighted average basis, not the best or worst outcome basis. The interpretation of a significant proportion of the change in this paragraph is related to the change in the cash flows of the underlying items and the expected changes in the policyholder share. IFRS lacks specific guidelines necessitating each insurer to establish internal quantitative criteria. Actually, concerns have arisen regarding the potential disparity in accounting for economical similar products, for example, interest rate linked and variable insurance products. Additionally, comparability issues emerge in assessing whether the contracts have direct participation features in certain cases, where they have different types of riders with exactly the same host contracts. This means if the rider's magnitude exceeds a certain threshold, entities may apply a different model than the VFA regardless of the host contract. Thus, the insurer's judgment holds great significance in this determination. Furthermore, a contract meeting all conditions may be deemed to entail an obligation to pay the policyholder an amount equivalent to the fair value of the underlying items, reduced by a variable fee for services. In this context, the variable fee represents compensation received by the insurer for rendering services such as an asset management alongside insurance coverage. It constitutes the primary revenue stream derived from the contract. Moving on, the GMM and the VFA have something in common in that they both have BEL, RA, and CSM as an element for insurance contract liabilities. In addition, the initial CSM measurement method is the same for both models. Finally, changes in the estimate of fulfillment cash flows that are related to future services are adjusted in CSM, while those that are unrelated are recognized in profit or loss statement. However, they show differences in how they account for the effect of the changes in underlying items, including investment returns, as demonstrated by this second category. In the GMM model, the investment return is treated as a PL or OCI items because it is determined at the discretion of the insurer. This is because under GMM, the insurer essentially keeps the profit from the invested assets and distributes a portion of them to the policyholders. However, in the VFA model, it is an explicitly determined item and considered related to the future provision of services. Essentially, any gains regarding the invested assets belong to the policyholder, and some proportion charged to the policyholder for providing the service, such as an asset management fee, goes to the insurers, which means the insurer's share is more explicit. Therefore, entities shall adjust the CSM under the VFA model. Moreover, the interest rate related to the insurance contract liabilities differs in that GMM measures it at the discount rate at initial recognition. while the VFA measures it at the current discount rate. Finally, changes in economic assumptions are recognized in profit or loss, or OCI, in the GMM model, while the VFA model adjusts the CSM. These differences in measurement models have significant implications for the life insurance industry. In the case of one of the major life insurers, if the discount rate changes by 10 basis points, the profit and loss might change by trillions under the GMM. However, if the VFA is applied, then the CSM is adjusted, which can mitigate the volatility of profit and loss. In terms of profit and loss management, the VFA might be a preferred model in practice. Also, in terms of system management, the VFA has the advantage of applying the current discount rate when calculating interest. So it can be easily calculated without having to consider the historical discount rate each time. For the last section on the VFA, we'll discuss its main components. First, let's start with the insurance contract liabilities. The underlying items are comprised of the policyholders and insured's share. The policyholder share is the present value of the future cash outflows, including potential charges on cancellation or surrender, subtracted by the premiums which represent the present value of future cash flows. The insured share is the fair value of underlying assets subtracted from the policyholder share. This includes the cash flows that do not vary based on return on any underlying items. As outlined in IFRS 17, paragraph B113, these components encompass the time value of money and the effects of financial risk. In conclusion, the sum of policyholder share and the cash flows that do not vary based on returns on any underlying item is BEL plus RA, or the fulfilling cash flows. In addition, CSM is calculated by the insurance share minus the cash flows that do not vary based on the returns on any underlying items. Cash flows unrelated to the underlying items refer to expenses that insurers are obligated to cover for policyholders, regardless of external circumstances or fund performance. These include the present value of cash outflows that are not deducted from the fund, such as death and accident benefits, as well as acquisition expenses. Some other non-underlying items include the present value of premiums not allocated to the fund, such as risk premium, loading premium, and the time value of money and effects of financial risk. The second part involves the computation of the variable fee. Here, an entity receives premiums of 1,000, with 900 invested in a fund which is considered an underlying item. The risk premium, designated as 80, represents the coverage-related premium, while the loading charge, set as 20, covers acquisition and maintenance expenses, among others. If the fund's fair value increased by 20% over a year, the underlying item's new valuation stands at 1,080, which means the amount of the insurer and the policyholder share is then determined by the insurance contract, initial contract. Assuming that insurance share of the first year's fair value appreciation is 5%, the corresponding amount is calculated as 9. As a result, the variable fee is subsequently calculated by subtracting the time value of money from 9. Lastly, we'll discuss the recognition of insurance revenue and expenses. The initial recognized CSM is amortized to insurance service result and classified under profit or loss. Changes in future cash flows due to past services are similarly accounted for in profit or loss. Similar to the GMM, risk adjustments are also recognized within profit or loss through amortization. However, the treatment of the time value of money differs from the GMM, splitting into two segments: interest expenses and the changes in economic assumptions. Interest expenses fall under the investment income and expenses category, whereas changes in economic assumptions are recognized as CSM and amortized over the coverage period. So far, we've covered the basic concept of IFRS 17 and several measurement models such as the GMM, the VFA for life insurers. I hope this information is helpful for you to recapture the core contents of IFRS 17. And I will wrap it up here, and now we can start a 15-minute break and we'll pick it up later. Thanks for your attention. 어렵습니다. 다음이 좀 더 문제일 것 같은데
왜?
시간이 조금 애매하게
왜? 시간이 왜?
반반인데
응.
지금 한 40분 지난 거 아니에요?
아니야. 우리 15분 했잖아. 거의 1시간 썼어. 그래서 지금 한 10분 쉬다가 하면
15분 쉽니다.
15분 쉬고 그 다음에 내 생각에 거의 풀리 다 채우겠는데 뭐.
알겠습니다.
질문 한 개도 너무
잘 되고 있어. 잘하고 있어.
중간에 슬라이드 하나 놓쳐가지고
슬라이드 하나
깜짝
놓쳤어.
놀랐네 진짜.
근데 이런 식으로 하니까 괜찮네. 이게 어떻게 보이냐? 이게 화면 보이고 이렇게 하는 게 있어요?
네네 있습니다. 발표자
일단 요걸로 컨트롤하는 거죠.
네.
보이나?
일단 쉬었다가.
알겠습니다.
Yes. Yun.
Ladies and gentlemen, may I have your attention, please, as we like to continue our session with Miss Yo. Thank you.
All right, I hope you enjoyed our break and really are eager to hear more about next slide. So I'm gonna go ahead and resume with chapter 4. In this part of the presentation, we'll be looking at some of the practical challenges covered in chapter 4 and some requirements of IFRS 17 were actually quite different from the previous standard that the Korean insurance industry had been applying. The introduction of IFRS 17 was such a major change in insurance accounting in Korea. There were constant discussions and concerted effort to understand the newly defined concepts and apply them in practice, and we successfully adopt IFRS 17. So throughout this chapter, I will share the key accounting policies of life insurance in Korea, addressing key requirements set out in IFRS 17. Nepal may face similar issues in the future, so this can be a valuable reference. I hope that this will help answer some of your questions too. Let's start with a detailed look at accounting policies around the unit of account, contract boundaries, insurance finance income and expenses, and other accounting policies. Unit of account in IFRS 17 is somewhat different from other IFRS standards because the preparer should identify portfolios and groups of insurance contracts. Therefore, there are 4 major issues regarding the concept. Let's dive into the policy about identifying portfolios. We identify portfolios by classifying contracts subject to similar risks, and we reuse the category we already defined under the previous standard. As you can see on the middle of the slide, Korean major insurers divided all life insurance contracts into 4 groups: death, health, pension and savings, and others, assuming that each contract within the same group has similar risk. For subcategory, we decided to segment groups into non-par, participation, and variable contracts because they are managed in different ways. And this way, life insurance in Korea have reutilized the way of classification in accordance with the previous standard, the IFRS 4, and reorganized them into portfolios as defined in IFRS 17. Furthermore, we applied consistent accounting method within the same portfolios. For example, we applied the exact same measurement model for each insurance liabilities and the same accounting policy to recognize the effect of a change in discount rate. There are several accounting policies that we need to focus on with regard to identifying group contracts. To start with onerous contract, there was a concern how to assess the possibilities of the group contracts become onerous. There's no definitive guidance on IFRS 17 because IFRS itself is pretty much principle-based standard. So one of the major life insurers in Korea introduced a confidence level approach to find out whether a group of contract might be onerous. I summarized the detailed criteria how the confidence level approach works. If the 2RA exceeds CSM, a group of contract considered not to be onerous. If CSM is between 0 and 2RA, it refers to that the group of contracts have no significant possibilities of becoming onerous. Finally, in all other cases, a group of contract is onerous. Second thing to consider regarding a group of contracts is the level of aggregation. we set the level of aggregation is an annual cohort, not biannually or quarterly. Also, in terms of discount rate, most life insurers adopt moving average interest rate within the same cohort. The last question that comes in is how to apply the variable fee approach. IFRS 17 outlines the criteria for applying the VFA. Contracts that meet all of the following criteria can be measured under the VFA model. Firstly, the contractor terms specify that the policyholders participate in a share of a clearly identified pool of underlying items. Secondly, the entity expects to pay the policyholder an amount equal to a substantial share of the fair value returns on the underlying items. Finally, the entity expects a substantial proportion of any change in the amount to be paid to the policyholder to vary with the change in fair value of underlying items. However, in applying this criteria, it is unclear what substantial means in this context. Therefore, major life insurers addressed this problem by setting their own definition of substantiality. They define the term by using two different aspects. In a quantitative context, if more than 50% of the cash flows is to the policyholder, it's considered substantial. In a qualitative context, they quoted IFRS 17 and noted that treaties, options, and guarantees within the contract should be considered as a basis for judgment. Next, let's discuss contract boundaries. We determine these boundaries and we measure them at each annual reporting period. IFRS 17 provides guidance on setting these boundaries as shown on this slide. An entity shall include in the measurement of a growth insurance contract all the future cash flows within the boundary of each contract in the group. Moreover, the standard stated that cash flows are within the boundary of an insurance contract if they arise from substantive rights and obligations that exist during the reporting period in which the entity can compel the policyholder to pay the premiums, or in which the entity has a substantive obligation to provide the policyholder with insurance contract services. Lastly, an entity set contract boundaries under the criteria where the entity has the practical ability to reassess the risks of particular policyholder or portfolio, and as a result, can set a price or level of benefits that fully reflect those risks. In addition, there are specific practical applications in determining contract boundaries. Some life insurers in Korea assess contract boundaries based not solely on the host insurance, but on the level of insurance contract comprising of the host insurance and the riders together. Furthermore, when assessing contract boundaries, they consider the host insurance's maturity with regards to the insurance contract with renewable rider. For instance, if the maturity for host insurance is 3 years, whereas the renewal period for the rider is 5 years, the range for a contract boundary is considered 30 years. Finally, entities include the insurance loading option in the future cash flow items within the boundary of each contract in the group. Now let's shift our focus on accounting policies on insurance finance income and expenses. One major Korean life insurer tended to disaggregate these items into both PL and OCI categories. This is done mainly in the interest of providing useful information to users by clearly presenting the source of profit or loss. In practice, PL and OCI items are differentiated depending on the nature of the asset when entities choose to disaggregate insurance finance income or expenses. In many cases, Korean life insurers hold financial instruments recognized as FVOCI items. In turn, most insurance financial income or expenses are then considered OCI items. Furthermore, IFRS 17 requires systematic allocation of these items over time. So IFRS 17 paragraph B132 provides two guidelines. Number one, using a rate that allocates the remaining revised expected finance income or expenses over the remaining duration of the growth contract at a constant rate. Or number two, using an allocation that is based on the amount credited in the period and expected to be credited in the future periods for contracts that use a crediting rate to determine amounts due to the policyholders. But other than that, it doesn't give specific instructions, leaving room for interpretation. This ambiguity raises another issue. One entity raises a question on how to recognize profit or loss stemming from differences between the expected and actual crediting rate, which is recognized in insurance finance income or expenses. In response to the inquiry, entities should allocate the difference as OCI items once they apply the EIR method. On the other hand, entities applying the PCR method can recognize the amount as PL items if they provide reasonable explanations. Finally, let's explore some additional accounting policies that implemented in current practice by life insurers. Firstly, for the changes in the risk adjustment for non-financial risk, IFRS 17 allows two accounting methods. Entities are allowed to adjust the CSM for all changes, or they can disaggregate the changes in RA between two separate segments. This means that insurers should adjust CSM for the change related to the non-financial risk, while the one related to financial risk should be recognized as PL items. One of the major life insurers in Korea disaggregates the changes in RA into these two separate parts. The entity accounts for a change in RA related to financial risk as P&L statement items and allocates the amount to PL items and OCI items. In practice, there is diversity in how to account for the changes in RA. Secondly, let's address the adjustment of the assumptions for the financial statement disclosures. These are crucial in IFRS calculations, so life insurers in Korea adjust economic assumptions quarterly. As for actuarial assumptions, we adjust them annually as of the end of December. Finally, I wanted to discuss the transition approaches used by Korean life insurers when first adopting IFRS 17. For context, there were extensive internal discussions to decide among full retrospective, modified retrospective, and fair value method. In this case, modified retrospective method describes a policy of applying IFRS retrospectively in their own specific ways. So most life insurance companies in Korea have decided to choose either the full retrospective approach or the fair value approach. This decision was based on a practical concern. What I mean is that entities should build a system to meet the requirements under IFRS 17. Now let's look at the practical application chosen. As I said earlier, in order to first adopt IFRS 17, an entity should build a system that separates direct and indirect costs to calculate best estimate liabilities. Thus, entities in Korea concluded that it is practical to apply full retrospective approach when they set a newly developed system for IFRS 17. The retrospective period is typically set between 1 and 5 years, and the exact period for each case is determined via the board of directors. Moreover, the concept of fair value referenced in the fair value method is exactly the same to the one defined in IFRS 13, fair value measurement, with small tweaks. This is outlined in the regulatory guidance in Korea. For further information, please see the materials related to the statutory accounting principle session for the yesterday. Moving on to Chapter 5, I will deep dive into practical issues regarding IFRS 17 in Korea. This chapter contains a lot of insight into the interpretation and understanding of IFRS 17 from different points, which can help you to have a broader perspective. After the adoption of IFRS 17, there have been many inquiries in relation to how to account for specific events, and I have prioritized the most important issues that hold significant implications. There are 3 issues I'd like to address. Firstly, I'll look at how to account for the differences between the expected and actual claims before turning to discuss PL approach versus OCI approach when recognizing contracts from financial statements. Finally, I'll look at the application of the variable fee approach model. Let's start with the first issue. To give some background, one entity raises the question of how to account for the subsequent changes in fulfillment cash flows, including how to recognize the profit or loss related to this specific case when there is a difference between the expected and actual claims. You can see the illustrative example below for further understanding. Regarding this situation, there are 2 questions arose from some stakeholders. Firstly, should actual claims to be considered a provision of insurance contract services and therefore be considered insurance revenue? Secondly, should subsequent changes in fulfillment cash flows resulting from experience adjustment be considered insurance revenue as well? We, the staff at KASB, analyzed the issue and concluded that actual claims should not be considered as insurance revenue. Also, a change in the estimates of future cash flow resulting from insurance adjustment should not be recognized as insurance revenue, rather be treated as CSM. To be specific, I'll give you a detailed analysis regarding question 1. The contracts subject to IFRS 17 are beyond the scope of IFRS 15. Thus, the argument that IFRS 15 should be applied in accordance with IFRS 17, paragraph B1 to 3 is not valid. Insurance revenue from insurance contract is subject to IFRS 17, and an entity shall recognize insurance revenue as the reduction in the liability for the remaining coverage period. Furthermore, an entity's insurance service to policyholders is not the payment of claims, but rather standing ready to meet valid claims. Thus, actual claims should not be recognized as a service provided. Therefore, we must conclude that there's no room to recognize insurance revenue. Moving on to question 2, experience adjustment arise from differences between the expected claims and actual claims. This results in a change in the estimates of future cash flows, which adjust the CSM in accordance with IFRS 17, paragraph B96. Insurance service expenses referenced in IFRS 17, paragraph 1 to 4 is more likely referring to the insurance service expenses expected to be incurred in the current certain period. There's no concrete evidence for the argument that a change in the estimates of future cash flow resulting from experience adjustments should be recognized as insurance revenue. Let's now turn to discussing the practical issue of accounting for the remaining amount in OCI regarding the recognized contract upon the elimination. Let me deliver some simple background information. So paragraph 88 of IFRS 17 includes an accounting policy that allows choice between A, including insurance finance income or expenses in profit or loss. This is called the PL approach. Or B, disaggregating insurance finance income or expenses to include in profit or loss an amount determined by a systematic allocation. For interest rate linked contracts that apply the OCI approach, the residual amount in OCI items arises and a contract lapses before the end of the coverage period. This is due to the difference between the change in the fulfillment cash flows adjusted by the paragraph 76 and the changes in the CSM by paragraph 76, section 2. The Korean life insurance industry most commonly applies the OCI approach, which raises the question of how to account for the remaining OCI amount arising on the derecognition of such contracts. Regarding this situation, there are differing views on how to account for the remaining OCI amount. Some stakeholders consider recognizing the remaining amount of OCI item regarding a lapsed contract as profit or loss when the contract is derecognized, while others have argued that preparers should allocate the remaining amount in OCI items over the duration of the growth contract and recognize it as insurance finance income or expenses. Our opinion is that view 1 and view 2 are both feasible options for addressing the remaining amount of OCI item when the contracts are derecognized. IFRS 17 provides a detailed procedure solely for the adjustment to the fulfillment cash flows and contractual service margin when a contract is derecognized, with no measure for the remaining OCI amount. Furthermore, IFRS 17, paragraph 91 only addresses the accounting for OCI items when a contract is derecognized in special circumstances. In conclusion, both view 1 and view 2 are applicable in other general circumstances. Final issue I'd like to address is about the application of the VFA to a variable annuity insurance contract. For some background information, an entity issued a variable annuity insurance contract with 2 parts of sub-coverage periods. Each sub-period in this contract has different characteristics. The first period shows direct participating features, and premiums from policyholders are managed as a fund. Therefore, it is qualified for the VFA. On the other hand, the second sub-coverage period has indirect participating features and is managed as a general account. A crediting rate is then applied to the policyholders' accumulated reserves. This leads to the conclusion that the second period is not qualified for the VFA. To wrap it up, in terms of total coverage period, this contract meet three conditions for the VFA, despite no qualification for this approach in the second sub-coverage period. For further understanding, here I wrote detailed concepts of the crediting rate and insurer's variable fee, including referenced paragraphs on this slide. Moving on to the next page. The question at hand is how to account for the changes in the fulfillment cash flows related to announced benchmark rate in the second sub-coverage period. According to some stakeholders, the amount referenced in this question should be recognized as insurance finance income or expenses. Even if the policyholder does not participate in a share of a clearly identified underlying item, the announced benchmark rate meets the definition of an underlying item. This is because the variable fee for the investment-related service is not determinable. According to IFRS 17, the benchmark rate could be regarded as the policyholder's share given its economic substance. If the second sub-coverage period is separate and independent, the insurance contract in this period would be an interest rate linked and would not meet the conditions for the VFA. As a result, the entity should apply the GMM for the contract. In fact, there is little difference between the GMM and the VFA models, and for total coverage period, the contract meets conditions for the VFA. Thus, it is plausible to apply the VFA model for this variable annuity insurance contract. However, there is a different interpretation that treats this as an adjustment of CSM. In the second sub-coverage period, the fulfillment cash flows related to the announced benchmark rate do not meet the conditions that IFRS 17 stated for the VFA application. Therefore, there's no clearly identified pool of underlying items. As a result, the underlying item is not linked to the fulfillment cash flows, which means the cash flows do not vary based on the returns of underlying items. Regarding to the contract having no clearly identified underlying items, the fulfillment cash flows related to the benchmark rate should be regarded as the cash flows that do not vary based on the returns on underlying items. This is in accordance with B104 of IFRS 17. Therefore, the changes in the fulfillment cash flows should adjust the CSM as stated in the paragraph B113 and 114. We analyzed this issue by tracking down research papers, as well as conducting internal discussions and informal Zoom calls with IASB staff. At first, it was somewhat difficult to get to the core of this issue and set our stance on the matter. But in the light of our research, we reached a kind of definitive conclusion. Our conclusion supports the second view, that the changes in fulfillment cash flows related to announced benchmark rate in the second sub-coverage period shall adjust CSM. Evidently, all the underlying items terms detailed in the requirements for the VFA shall be within clearly identified pool of underlying items. In addition, we believe that the addressed benchmark rate is not within a clearly identified pool of underlying items. This is due to the discretion of insurer in determining both insurers and policyholder share. In addition, cash flows related to the benchmark rate are considered fulfillment cash flows that do not vary based on the return on underlying items. Therefore, the change in the fulfillment cash flows should adjust CSM according to IFRS 17. The following two slides show the paragraph that our staff analyzed to reach the conclusion regarding issue 3. As you can see, our opinion is based on a solid foundation under IFRS 17. Now let's look at the detailed responses to the questions from Nepal. First of all, I would like to thank the stakeholders from Nepal for sending us their questions in advance, because this helps to understand your needs and to find kind of the trajectory of the presentation. Although most of the original questions touched on crucial parts, for the sake of this session, we've selected a few after internal discussions. These were initially reorganized to focus on what we deemed to be the key point of each section. As I indicated earlier, if you have further questions, we'll be very happy to answer them after the presentation. Anyway, we've divided questions into 6 parts. So let's start with the level of aggregation of insurance contracts. Question 1 is in regard to the level of aggregation in insurance contracts. There are concerns regarding expected substantial change in recognizing portfolio in accordance with IFRS 17. The main issue lies in the discrepancy between the categorization of accounts. While preparers in Nepal split accounts into 2 categories, such as participating and non-participating contracts, IFRS 17 differs in its categorization criteria. The standard clearly divides a portfolio of insurance contracts into 3 distinct groups. Onerous contracts have no significant possibility of becoming onerous, and the remaining contracts. To answer your question, the classification of non-participating and participating contracts is more likely to be related to insurance portfolios, not the group. And as I noted earlier, portfolio should be disaggregated into at least 3 different groups under IFRS 17. And the standard also requires to apply annual cohort. Also, while discussing this issue, we had a chance to take a look at our own experience after we decided to adopt IFRS 17. When IFRS 17 was first adopted in Korea, there were discussions about how to define risk and group contract together. Theoretically, we would have to disassemble all the contract iterations and regroup them into portfolios under IFRS 17. However, it turned out that this is virtually impossible due to the existence of inseparable risks. Therefore, we identified representative risks and grouped contracts as defined by IFRS 17 using previous categorization. Under the previous standard, Korean life insurers categorized their products into death, health, savings, and others. Following the adoption of IFRS 17, they mapped each reported line item using the new requirements. Under the current practice in Nepal, there are regulations regarding the identification of insurance contracts. So in theory, preparers should be readily capable of identifying the representative risks for each group and classifying them according to the IFRS 17. So yeah, please note that IFRS 17 leaves a room for different judgments between the diversity accounting. And the next page is about measurement approaches. There are concerns regarding guidelines about the asset share approach in VFA model. To be specific, life insurers might require the calculation of asset share of each portfolio or group of insurance contracts to comply with the standard. Regarding the asset share approach, we should be aware that this approach is not the insurance liability measurement model. Rather, the calculation is amount equal to the future cash flows divided by the cost of capital, which leads to the conclusion that this is unrelated to fulfillment cash flows. From our understanding, life insurers in Korea do not apply the asset share approach to measure insurance contracts due to their inherent compliance with IFRS 17. In addition, applying the VFA model is only necessary if the contract contains a direct barrier product or unit-linked item. For your reference, I'd like to remind you the question on whether certain contracts are subject to the VFA model. You can see the previous question on chapter 5, issue number 3. Let's move on to the third question, which concerns measurement on initial and subsequent recognition. There are concerns regarding revisiting cash flows items to calculate fulfillment cash flows in IFRS 17. Current practice defines its own cash flow items to calculate liability, which is not consistent with that defined in IFRS 17. Based on our understanding of the questionnaire, Nepal already has a current practice of LRC calculation for the insurance contract, which means you have different DCF models. Therefore, the key issue is whether the cash flows currently included in the insurance liability fall within the scope of the fulfillment cash flows as defined in IFRS 17. Life insurance in Korea had faced similar issues regarding cash flow items to calculate fulfillment cash flows. We found that this classification of overhead items in IFRS 17 was different from the previous standard. The first discrepancy was regarding training and education expenses, which were included in the calculation of LRC under the previous accounting standard. However, under IFRS 17, training and education expenses are excluded from the fulfillment cash flows as they are not related to the fulfillment of the contract. Secondly, property and maintenance expenses were considered a cost under the previous standard, whereas IFRS 17 now includes these expenses as cash flows if they are related to the fulfillment of the contract. Consequently, property and maintenance expenses are divided into two groups: investment managed expenses, which are directly related to the fulfillment cash flows, and all others, which are simply considered cost. Through the similar process, such as modifying specific items, insurers in Nepal can easily convert the existing LRC DCF model to the cash flows required by IFRS 17. This slide covers the question of insurance acquisition cash flows. There are concerns regarding how you account for the insurance acquisition cost. To elaborate, IFRS 17 does not explicitly set out the concept of deferred acquisition costs. Thus, the amortization method should be provided through regulatory guidance. According to our analysis, the fulfillment cash flows under IFRS 17 consist of fixed cost and variable overhead cost, which is a broader concept than the US GAAP's definition of attributable and non-attributable concept. In other words, except for items that are explicitly mentioned, such as cost of accounting human resources, if a cost is related to the fulfillment of contract and can be systematically allocated over a period, it is considered a direct cost. In addition, there is no existing accounting policy in IFRS 17 for prepaid expenses made in advance of the insurance contract, such as recognizing them as an asset and subsequently deducting them from the insurance liability. Most of the deferred acquisition costs are cash outflows, both in the year of the contract and in the following year, but are systematically amortized to maturity. These costs do not amount to a net profit or loss, as they are recognized both revenue and expenses. Thus, they do not impact the overall income statement. Furthermore, there's no specific regulatory guidance in Korea regarding the amortization method, which means it is left to the discretion of companies. The following slide goes into detail regarding the issue of the first-time implementation approach. There are concerns regarding initial application of IFRS 17. Of all the transition options, the retrospective approach defined in IFRS 17 involves the highest level of effort, and there may be some challenges regarding the view and the revision of prior accounting systems and data. As this approach calls for the total overhaul of all previous records, we noted that IFRS 17 specifies that all entities are to apply IFRS 17 using retrospective approach. In certain circumstances where there is unfeasible, there may be some alternative options available. In this case, these alternatives include the modified retrospective approach and the fair value approach. This alternative path can be implemented if and only if it is impracticable for an entity to apply IFRS 17 retrospectively for a group of insurance contracts. The retrospective approach requires the entity to adjust all economic actuarial assumptions for each contract. And the modified retrospective method sets specific areas to be revised with more simple requirements. This method is structured to achieve the closest outcome to retrospective application. Lastly, the fair value method requires the adjustment of only those contracts held as of the transition date, not before. Most life insurance companies in Korea have decided to apply the full retrospective approach in close cooperation with regulators. This is because it allows them to comply with IFRS 17 using reasonable and supportable information without expending undue cost or effort. By implementing this strategy, we can successfully adopt IFRS 17, making our financial information compatible with other entities within the insurance industry while minimizing transition cost. The last question I'd like to deal with is related to presentation and disclosures. There are concerns regarding amended requirements of presentation and disclosures in IFRS 17. IFRS 17 doesn't seem to allow recognition of collected premium as income. Rather, it requires the separation of the investment component of the total revenue. However, the total collected premium is considered a standard price to pay the service fee to Nepal Insurance Authority. You understood this issue and found out that there is a clear answer in IFRS 17. According to paragraph 105 of IFRS 17, an entity shall disclose separately the amount of cash flows in the period, including premiums received for the insurance contract issued. Therefore, even though the collected premium is not considered revenue in IFRS 17, stakeholders shall find the amount of collected premium for each financial reporting period via the information in the notes. So please see the notes of the company VIP for your reference on the right side of the slide. That marks the end of responses from our side. So I hope my explanations have been helpful in covering your concerns regarding IFRS 17. This is the appendix section, and we provide the financial statements of Samsung Life Insurance, one of Korea's leading life insurance companies, for your reference. As one of the first companies to successfully adopt IFRS 17, it's very helpful to review how the statement of financial position and income statement are presented. So today we've explored a brief summary of IFRS 17 for life insurers and discussed key accounting policies and practical issues in Korea. Lastly, I set time at the end to provide responses to the questionnaire sent beforehand. I hope this presentation has improved your comprehension concerning this issue around the application and provided insights as how to apply IFRS 17 going forward. Again, I'd like to express my gratitude for allowing me to share our thoughts regarding IFRS 17. Thank you very much.